Hi everyone, welcome to Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today we're breaking down the two leading benchmarks that measure consumer attitudes. While our financial markets have been showing remarkable resilience and performing incredibly well lately, the average American consumer is telling a completely different story. Before we look at the raw numbers, let's address the elephant in the room. Why is the Conference Board's Consumer Confidence Index significantly higher than the University of Michigan's Sentiment Index right now? It comes down to methodology. The Conference Board focuses heavily on the labor market from the worker's perspective, asking consumers if jobs are plentiful or hard to get. Meanwhile, the University of Michigan focuses much more on household finances, the impact of inflation, and employment conditions from the business perspective. And because the job market remains historically tight, the Conference Board Index gets a defensive anchor. Meanwhile, the University of Michigan catches the full, unfiltered blast of inflation pain. Let's take a look at the University of Michigan Consumer Sentiment Index first. The final May report shows that the Consumer Sentiment Index plunged to a historic low of 44.8. This is worse than the depths of the 1980 inflation crisis, the 2008 Great Recession, and the previous historical trough from 2022, when inflation reached a multi-decade high. Consumers are reporting severe concerns over their cost of living as high prices continue to erode their personal finances. When we break the index down into its core components, we see that the pain is evenly distributed. Current economic conditions sit at 45.8, while the index of consumer expectations is at 44.1, both record lows. Consumers feel terrible about their circumstances today, and they see almost no relief on the horizon for the next 6 months. Now we can get a bit deeper into the why behind this historic drop. Sticky inflation worries. The one-year inflation expectation is up to 4.8%. But even more concerning for the Federal Reserve is the 5-year inflation expectation, which has climbed to 3.9%. Consumers are essentially reporting that they no longer view high prices as a temporary blip. They expect inflation to be structural. And former Fed Chair Jerome Powell has often warned that what people believe will happen to prices in the future heavily dictates how they behave today. Now let's switch gears to the Conference Board Consumer Confidence Index. Here, the headline number looks completely different, standing at 93.1. And while this is well below the 2020 peak, it represents a completely different psychological tier than Michigan's current record low reading. Let's look at the components to see why. The divergence within the Conference Board data becomes more obvious. The present situation index is still quite robust, hovering up near 121. Why? Because people still have jobs and their wage income is steady right now. However, the expectations index is sitting way down, near 74, well below the orange 80 line that historically signals an impending recession. So even within this index, consumers are saying, my situation is okay today because I'm employed, but I am incredibly anxious about tomorrow. And the Conference Board's inflation data mirrors the anxiety we saw in the Michigan survey. The expected average and median inflation rate for the next 12 months remains elevated. So no matter which survey you look at, high prices, specifically food, rent, and gasoline, remain the number one concern weighing on the American household. Now, historically, these two surveys have tracked together, moving hand in hand through economic cycles, though the Conference Board has been slightly more volatile, experiencing higher highs and lower lows. But look at the far right edge of the chart as of May 2026. As we've already touched on, the teal line for confidence remains relatively elevated, while the purple line for sentiment has plunged entirely straight down. This represents a historically rare decoupling of the two indices. We're now looking at the historical spread between these two major indices. When the teal bars are high, it means the Conference Board is drastically outperforming the Michigan index. As you can see on the far right, we're currently living through one of the widest positive spreads in the history of economic data. And to take it a step further, this next chart gives us a macroeconomic justification for this gap by overlaying it with the federal funds rate. Notice how every time interest rates spike sharply, the spread expands. Elevated interest rates hit the Michigan survey instantly because they crush buying conditions. To prove this isn't just a scaling issue, I've indexed both metrics to a series average of 100. But even when smoothed out with 6-month moving averages, the current gap is historic. The purple line of sentiment is dragging along the bottom, while the teal line of confidence is struggling, but mimicking a standard mid-cycle slowdown. It's a stark reminder of the K-shaped reality facing consumers. It's clear that we're dealing with a deeply divided consumer profile. The employment safety net is working overtime, keeping high-level confidence steady. But the reality of everyday living expenses is entirely overwhelming consumer sentiment. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Charts section.